Hey, welcome to the Guaranteed Retirement Guy Show. I'm happy to have you. And today I'm going to be talking about how your annuity income is taxed. So, how is it taxed? Well, it really depends on the type of account that funds your annuity. So, you've got two different types of annuities as far as income. You've got an annuity that is funded from like a 401k or an IRA or some kind of tax deferred account, or maybe it's a Roth. If it's a Roth, obviously everything is tax free. Or you have an annuity that is maybe it's funded from a brokerage account or from cash. Maybe you got cash lying on your mattress, or maybe you got some money sitting in a bank account from an inheritance. Really, it doesn't matter. It's just if it's outside of a 401k or an IRA or 403b or any of these other um, IRS sponsored, baskets where your funds are subject to the rules and laws, restrictions of the IRS, then it's non-qualified. Okay. So any money outside of those is non-qualified. Cash, savings, brokerage, whatever. Diamonds. Yeah, I had a client who had diamonds. He had $500,000 in diamonds sitting in his house, which I think is crazy, but that's what he had. So if that's the case, then what you're doing is you're taking that money. Okay, maybe you're taking $500,000 and it's non-qualified. So it's already taxed, right? You've already been taxed on that money. So you take that $500,000, you stick it into an annuity, and let's say when you activate that annuity income, it gives you $50,000 a year in guaranteed income the rest of your life. And let's say before you activate that income, maybe that $500,000 has already earned $150,000. So the account is worth $650,000 when you actually activate the income. So if that's the case, then what's going to happen typically is you'll get taxed on the first 3 years of income because they're taking out earnings first. Okay, the earnings came in last; they're taking it out first. They want to tax you on those earnings first. And so, first 3 years, you're taking out $50,000 a year until you use up that $150,000 in earnings. That's all taxable. Then, for the next 10 years, you're taking out $50,000 tax free, right? Because you've already paid taxes on that money, right? You already put $500,000 in, and it was already taxed. And so the income that you're getting from that is just basically they're giving you back your principal, right? So it's tax free. Any money after that, because remember, this is contractual, you're still getting $50,000 a year guaranteed for the rest of your life. So you take out $50,000 for another 20 years, you're taking out $1 million. That is taxable because that is considered earnings, right? That is considered a gain, right? Because the insurance company is paying you out a lot more than what you put in. And that's pretty typical for these annuities. You're always usually getting a lot more than you paid in. All right, so that's for the non-qualified side. If you are like most of my clients, you've got your money in a 401k or a 403b or maybe a TSP. Maybe you've got it in some employer-sponsored account that has been, you've been racking it up, you've been growing it, everything's been tax deferred because remember you've always got a tax break. Putting it in, they didn't charge you taxes on the money that you put in. And so it grows tax deferred until you start taking money out of it. Once you start taking money out of it, regardless if it's an annuity, if you take money out of a 401k or IRA, it's going to be taxed as ordinary income. That's all the earnings and that's all the money you put in. It's taxed as ordinary income. That's how that works. So the difference is if you take that money from a 401k or IRA, whatever tax deferred account, maybe it's a deferred pension, okay, whatever account that's tax deferred, you'll just transfer that into another basket, an IRA. So if it's a tax deferred 401k, it'll go into a tax deferred IRA. Same rules apply. The difference is instead of having your employer sponsored mutual funds in there, now you have an annuity contract inside that guarantees you'll never run out of income. So on one side, you may take out $50,000 out a year out of your $500,000 sitting in your 401k, and you're taxed as ordinary income. And at the end of 10 or 11 years, depending on what it's earned, you run out of money. You have no more money in there. So you're done. Versus having that same $500,000 going into an IRA with an annuity contract inside of it that gives you guaranteed income for life. Now, you're still taxed at $50,000 a year. That's still coming out. You're still taxed as ordinary income. The difference is you have a contract inside that stipulates and guarantees that money, that income will never run out. So that's basically how it works. So when you're looking at taxation, um, and of course, I guess I don't want to leave out Roth accounts, Roth IRAs. Roth IRAs can go into a Roth IRA. Roth IRA goes into a Roth IRA. When you purchase annuities with these Roth accounts, you would typically transfer from those Roth accounts into a Roth IRA, and the same rule applies. Okay, the Roth IRA, everything that comes out is tax free, right? The difference is you have an annuity contract inside of that basket, which ensures that income never runs out. So on the flip side, you might have a Roth IRA. You take money out of it; it's all tax free. So maybe you put in $150,000, it's growing to $500,000. Of course, you put in after tax dollars, so that means all of that and the earnings are tax free. You take out $500,000, it's all tax free. Okay, which is great. Difference is if you take the same 500,000 and transfer it into a Roth IRA over here with an insurance company with an annuity inside of it that guarantees you income for the rest of your life. The difference is now if you're getting 50,000 out a year, it's not going to end after 10, 11, 12 years. It's going to end when you die, and if it's joint, after your spouse dies. So you might take that out for 30 years. Okay, take out $1.5 million instead of the 500,000 or 600,000 that you'll take out of the non-guaranteed. So that's the difference. You've got tax-free, you got taxable, you got partially taxable if it's non-qualified. There's just a lot of things to think about when you're funding an annuity. But however you decide to do it, whatever vehicle you take it from, whatever basket you take it from, either a non-qualified or a qualified account, just remember that the annuity contract guarantees that income. No matter how it's taxed, it still guarantees that income for life. And you typically are getting a much, much higher ROI, return on your investment, versus just leaving it in your account and hoping for the best. It's a lot better to have it in something that guarantees you that income, guarantees it for your spouse if you have one, and gives you that peace of mind. So, all right, if that's something you want me to chat with you more about, if you want me to look at the numbers for you, kind of go through some scenarios, answer your questions. I'm not going to try to hard sell you anything, just want to help. And I'm happy to do so. Go ahead and click on the link below, go directly to my calendar and we will chat and look at your numbers, see exactly what it looks like for you. And then you decide. Okay. Happy to answer your questions and go over that with you. So anyways, thanks for watching. Appreciate you and look forward to seeing you in the next video.